Are you ahead or behind? What I want to do in this video is go through the median household savings, incomes, net worth, and so that you know exactly where you are, because right now it feels really weird. You can go online and some people feel like they're wealthier than ever before and they're spending it on everything, and then you reflect back and say, how? And for yourself, you might be making more money than ever before, but feel poorer than ever before. So let's take a step back and realize how well are we actually doing, and if there are some ways to work our way up that ladder. So if you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. In this video, I want to focus specifically on personal finance. It is very personal, so I can't give you financial advice, but I know one thing that I've been always thinking about, especially in my first 5 years of investing and in my early 20s, I always thought, was I behind? I'm working harder than ever before, I'm making more money, but I just feel like I'm barely holding on. And you might be feeling the same way at the moment. With a cost of living crisis, we've got a rental crisis, a housing shortage, and everything in between. I want to share up-to-date numbers so you get an idea of exactly where you are and whether you're being too harsh on yourself or you need to stop ordering Uber Eats. Let's dive into some numbers. I'm going to have the numbers pop up on the screen here as well, so it's not so overwhelming. Now let's look at savings by age. The Westpac customer data in Jan of 2025 shows stark gaps between the average versus median balances by age. For example, a 30 to 34-year-old average balance would be $21,394. However, the median actually drops to only $1,104. The same thing can be shown at 35 to 44-year-olds, where the average is $29,769, but the median is only $811. So you need to understand what the difference is between average and median. The average is actually really skewed because what you're taking is people that are making so much more and then having that averaged out with people that aren't making that much. However, the median is actually looking at that entire group and saying, what is the middle person actually making? And that's why looking at the median number is a more accurate representation. However, it's still very concerning when the average numbers are still so low. Now, the next thing to look at is your super balance. This is what you're relying on to retire. So according to the ASFA, the actual number that you want to be at when you get to 67 to have a comfortable retirement is about $595,000 for a single person, and that goes up to about $690,000 if you are a couple. Now, these numbers may seem low, and the reason for that is because it's taking into consideration you have no debt, so you own your own home, and you're also relying on the pension. Now, this is where it all comes crumbling down, because even if you really tried hard to go out there and have your super continue building, it's very difficult to maintain such a large super balance while still having your house paid off. And that's where we're going to look at some strategies later in this video as well. Now, according to the ATO, these are some of the average balances by age. Now, if you look at 40 to 44-year-old men, it's $139,000, whereas for women, it's $108,000. And then by the time women and men get to 55 to 59, so really getting to that age of retirement, you've got men at $316,000 and then women at $237,000. The reason why there's such a big gap, and the number is lower because we've got some households that still are privileged enough where they can have the female in the household take care of kids and stay at home, whereas in most cases, we can't afford that. And so what happens is women will go in and out of workplaces depending on what's happening at home, especially when it comes to family planning. And this number keeps getting wider because you have the compounding effect. As we know here in Australia, our super is invested with one of the big companies. They go and use that money and invest it into the markets, effectively gambling your money and investing for you. There's a conservative approach, and then there's obviously the higher risk plays, and they go out there to try and achieve a return for you. Now, generally, if you're getting 7 to 11% every year, you're like, I don't mind, because at the end of the day, that's growing in the background. I can't touch it right now, so I'm going to let it be. We've seen a massive rise in self-managed super funds, and that's where you're actually taking back that control and saying, no, I don't believe that you can outperform the market. I want to take control. I want to diversify it, not just in shares, but I might want to go in property, I want to buy Bitcoin and things like that. So there's been a massive rise in Australia when it comes to SMSFs. Now, I can't tell you whether you should set up an SMSF and go out there and buy property, Bitcoin, Pokemon cards, or anything like that. I've got a video here that can just educate you around how people are using their self-managed super fund to buy more property. The borrowing that you get in your super is different and is separate to you in your personal name. And that's why there's been such a big rise in popularity around people going out there and buying property in their super funds. So I urge you, if you are interested in buying property in SMSFs, go and check out that video. It's going to have a bunch in terms of results, starting points, and where it could potentially end up. So we've looked at savings balances. We've also looked at super balances. Now let's take a look at where the net worth is tracking you relative to where you are in the cohort of everyone else. Now, total household wealth hit a record of $17.3 trillion in the March quarter in 2025, and property is still the engine, with average wealth rising once again. Now, obviously in Australia, we have large portions of our wealth in real estate. Now, a lot of people have that real estate not in investment properties, but in their own homes. Usually when people buy their own home, they sit on it for years and years, and maybe 40 or 50 years later, realize that a lot of the gains in their net worth have come from just owning their own property. And that's not because the property they live in has become so much better. It's just that we're denominating that in a fiat currency, being the Australian dollar, and that continues to lose value every single year. So on paper, you're feeling like you're getting wealthier, but in reality, you're actually not. And that's because if you're not keeping up with the hurdle rate, which is how much inflation is really in the system and how much things are costing more relative to how much you're making, and the devaluation of currency, you're thinking you have to be growing at least 10 to 15% just to keep up. And that's why when you have a share portfolio and it goes up by 7%, or you go out there and you're saving your money in an interest account for 4%, you're like, why do I still feel poor? And why did everything become more expensive? It's because if you're saving at 7% or 10% and your hurdle rate is 15%, net over time, you're actually losing a lot of money. That's why I go and opt for higher performing assets, like something like Bitcoin. While most people think it's too risky and volatile, people do understand how property works. And the reason why property can go out and outperform all of these assets is because of leverage. Now, I'll talk a little bit more about property as we go through this, as to how you can level up through 3 layers as well. But if you're enjoying this sort of content, definitely smash that subscribe button. Now, let's look at the ABS microdata and show the typical or the median and tail cutoffs by age. So if you're in a young household, 25 to 40, the median net worth is $238,000. Now, if you actually work that out, 95% of this cohort have less than 1.56 million. So if your net worth currently, if your age between 25 and 40 is above 1.56 million, you're actually in the top 5% of this young cohort. We go on to the middle age, which is 41 to 64 year olds. The median is $809,000. But again, if you have more than 3.78 million in your net worth, you would actually be counted as the top 5% in that cohort. And finally, we look at the 65-year-old plus group, and the median there is $817,000. What you'll notice is from the middle age group, it doesn't actually improve a whole lot. The median was $809,000 in that middle age group, but in the retired, it only goes up to $817,000. Now, in order to be the top 5% of retirees in Australia, you would have to have a net worth of more than $3.78 million. It also really depends on where you live. Now, this net worth number really means nothing if you can't generate cash flow, have passive income, or be in a job that you actually enjoy. Because all you're gonna look at is the clock and say, hey, when can I run out the clock so I can enjoy my weekend? Or the 4 weeks a year that I get off. And then at the end of it, you get to 65 or 67 when you finally retire and you don't have enough money anyway. That's why you need to look at options outside of the box. And while most people think there is only one way to do this, which is work hard, buy your own home, get married, have kids, work until you're 65 or 67, I think there are other ways that you can go about it. And that's why you're here, that's why we've got solutions. Now, there's 3 things that you need to be really focusing on, and this is the key takeaway from this video. Number 1 is you've got to get your savings right and your investing strategy right. So what I mean by that is the income that you generate from your job or from your business needs to allow you to at least be investing about 20 to 30% of that in the market. If you're not doing that, it either means one of 2 things. 1, you need to increase your income by taking up a different job or side hustle, or you need to reduce how much you're spending. Now, reduce how you're spending could mean anything. It most likely means making your own food at home instead of going out to eat. But it could mean more than that. It means that right now you might be in a position where your rent's too high or your mortgage repayments are too high. That means you're gonna have to downgrade or move into a different area of Australia. Your dollars make a lot less sense in somewhere like Sydney and Melbourne where house prices are so high, relative to if you went out regionally or even went out to Western Australia where the prices aren't as crazy as they are in Sydney. So that then builds out your foundation. So if you've got layer 1, you look at your savings and investment ratios and just really solidify that. That's gonna allow you to start dollar cost averaging into anything. You know, if you really enjoy understanding how Bitcoin works, then you would choose that as your asset class. If you really go, hey, I understand ETFs, I wanna go down that path, or I wanna go out there and invest in myself or invest in my business. Now, layer 2 is where you start using accelerators. And now personally, I have a really strong belief that in order to go out and retire early, you need to use real estate full stop. One of the biggest advantages with real estate is using leverage. I can go to a bank or a broker and basically put 10% of a deposit in a property and they're gonna lend me 90% at the lowest rate. I can't do that with a credit card, can't do that with a personal loan. And if I go out there and try and do it with shares, I could do it, but the volatility and the risk associated with it doesn't make sense. So people are more comfortable taking on debt to go and buy property. The banks love it and you love it as well. So if you're able to go out there and start purchasing good quality real estate and you're able to do it with leverage, you're going to significantly outperform any of the numbers I've spoken about in this video. Obviously, I'm a real estate guy, but I'm also a Bitcoin guy. And to be honest, I was in shares and I sold it all for property. And I made a detailed video of how that all performed. There's some regrets in there, but you can definitely go check that out. And as I mentioned before, there's a hurdle rate. Here in Australia, it's probably about 15%. So if you go out there and you're investing in shares, unless you're picking individual companies, which is really difficult to pick, you're not going to outperform the 15% hurdle rate. If I get into property and I can use leverage, I can go out there and say, well, even if my property only grew by 5%, when even if the average is 8%, if I get 5%, I'm not getting 5% on the entire dollar value. Because I only put a 10% deposit down, that's pretty much a 4 to 5x on my return, which means that 5% is worth a lot more. Here's an easy example. If I bought a property for $600,000 and I put $60,000 into that property, if I went out there and that property grew by 5%, it means it went up by $30,000. And that means my $60,000 that went into the property generated me $30,000. Now I can't go in there and actually realize those gains. I also have to account for stamp duty and things like that. So my real costs are looking closer to about 100,000 in. And by the time I go in to take out some equity, which I can only take out at 90%, I'm probably looking closer to about $25,000 if it's 5% growth. So then in that case, I'm putting in 100 to make 25. That still means I'm performing at 25% in year one. And guess what happens? Year 2, year 3, year 4, and ongoing, the compounding nature means that my return cash on cash is far outpacing the hurdle rate here in Australia. This is exactly how I built all of my wealth, especially in my 20s. Now, if you're watching this and you're in your 40s, you're still very young. If you're gonna live till 90, you've still got another 50 years. You better start thinking about that stuff now. And we've got plenty of clients that contact me that say, hey, I'm in my 40s and 50s and I wanna look at buying property. And there's also those that are in their early 20s starting to buy their first property. If you need help with any of that, you can book in a free call. I'll leave a link in the description box below. Now, layer 3 is optimizing your super. Now, again, I don't really like touching on super, but I've made plenty of videos here about SMSFs, buying property, and how that all looks. You can look at the numbers and see what risk appetite you really have. Plus, it's also worthwhile understanding that if your entire strategy in your personal name is in shares, you might look at diversification. You might look at, hey, I've already got property in my portfolio, then I don't want to have my super in shares or in property either. You need to go out there, really strategize, but if you need to know how the numbers work, this is the place to be. The real reason we're making more money than ever before is because everything became more expensive and the dollar that we purchase everything with is actually losing its value. So could there be a world in which the median income in Australia is close to $1 million, if not $5 million? I totally believe that's going to happen unless something significantly changes. Which, to be honest, when you've got politicians coming in and being voted in for operating a country for 3 to 4 years, potentially getting a second term, they're not going to move the needle anywhere near enough for us to overcome this 15% hurdle rate. That's why I urge you to go out there, get educated. I've got 1,000 videos on this channel, like I'm not even kidding. I've also got 100,000 subscribers now, thanks to you guys. And I just want to keep growing this community so you can get yourself and your family into a position of financial freedom. If you need help with anything, I'll leave links in the description box below, and I'll catch you guys on the next one. Thanks, guys.